Good everyone. Today I'm working on through the particular project I'm working on, which is basically on Markov chain approach to modeling stock markets and trend transitions based on the probability of movements of stocks between the bearish, the bullish, and the stable states. So basically, I'm working on three stocks, which are the Microsoft stocks, the Apple stocks, and the Netflix stock market transactions. And basically, the reason why I chose this topic, I chose this Markov chain model, sorry, is because time series. Because Markov chain basically is doesn't depend on past observations and are basically trying to use the present conditions to predict the future occurrences. And the reason why I choose this particular project is because of how volatile stock markets can be, and due to their volatility and the unstable, um, the past observations might not really help to account for or predict the future occurrence. So that is why I chose to work with Markov chain model. And you also know that Markov chain model is also a specific type of time series analysis. So I'm going to be moving on to the problem statement of the problem, basically what we are trying to solve. And this is it basically. Now, like I said earlier, stock market prices basically fluctuate due to economic conditions, policy changes, and investor sentiments. That is, they tend to fluctuate because of their volatility, and due to their volatility, most investors basically trade blindly or buy stocks blindly because of they don't really study the pattern to which the stock market is actually going. They just buy it, sometimes buy based on belief, and it's actually a bad business for some because sometimes it turns out to be a bad business after investing blindly into particular stocks. And we know how these big companies work. For example, Google stocks, Apple stocks, for example, and Microsoft stocks are very, very big companies, and people tend to invest in their stocks a lot, and therefore, the volatility of the particular stocks actually increase and making it hard to predict. So, specific traditional probability matrices remain poorly quantified include the states change basically. So from bullish to bearish change, from bearish to stable state, and from stable to bullish state. So the reason why I'm using Markov chain basically, like I said, it actually offers a pattern to which these trends are following. For example, the probability of changing a particular state, that is probability of moving from bullish states to bearish states, and from bearish states to stable states. So why I chose this study basically, so it's to improve the understanding of how markets evolves across the bullish, bearish, and stable regimes, like I said earlier, using Markov chain because it is independent of the past observation and due to its independence nature, allows us to capture the trend of moving across the three states using the probability transition metrics, and it allows us to basically evaluate the risk that we're going to take, and you're also going to provide investment insight, that is, you're going to guide some investors into when to buy a particular stock, when to buy the stocks, that is the Microsoft stocks, the Netflix stocks, and the Apple stocks, and where to sell the particular stocks. And it also helps in stochastic applications. And so these are the specific objectives we are working on. Classify the stock price movement into bearish, bullish, and stable states using a defined threshold. Estimate the transition probability metrics governing movement between the three states, and also determine the long-run steady state probability of occurrence for each market state. And these are the previous researchers that worked on something related to the stock market. Rahim and Ezupe worked basically on Nigerian stock markets, working on three states, which is the positive states, negative states, and the stable returns. And what they were able to conclude was that stable returns basically dominated 59% of observation, and concluded that the transition probability metrics provide useful forecasting information for investors, which is basically aligning with our motivation of the study. and our problem statement actually. So that particular researcher was trying to do something related to risk assessment, and then they also classified money banks, deposit money bank study from 2010 to 2015, and were also able to conclude that Markov chain are effective for stock market prediction and investment planning. And these three researchers actually gives us go ahead and shows us basically that Markov chain can actually help us in what we're doing, and it's actually good for this type of particular projects. And what is our So this is our continuation of the study. Basically, we are trying to extend Markov chain application to stock market trade transactions beyond the banking sector and moving to stocks. And we are estimating the transaction probabilities among the three states using the structured modeling framework, like I've said earlier. And this is our model. This is our Markov chain model. As you can see, these are three states. Okay, so this is it. This is the Markov chain mathematical model. This is the next stage. Xt plus one is the next day. Like I said, Markov chain is another type of time series analysis, or this one is independent and is stochastic basically. So this is xt plus 1, where t plus 1 is the next stage equals to j, giving the previous day is equals to I. So this, for example, can be the next t plus 1 can be yesterday today, and no, t plus 1, sorry, can be tomorrow, and given that xt plus xt is equals to 1 is today returns or today's occurrences. So like I said, movements between states is described in international probability metrics derived from Pij. This is the probability of the next term or the next state is equals to Pxt plus 1 I is equals to J, given that Xt is equals to I. And this is our 3 by 3 international probability metrics because we're dealing with three states across three stocks. So which are the Microsoft, the Netflix, and the Apple stocks across the three states, which are the bearish, and bullish states. Then Then our expected outcome is a transfer probability matrix showing the movement probabilities, then identifying the dominant market state based on the long run frequency, a steady state probability distribution characterizing long run market behaviors, as well as an improved understanding of the market's persistent volatility and trend reversals. So basically, stock market behavior can be effectively represented as a stochastic process. Markov chain offer a transparent and mathematically grounded framework for analyzing trend transition, and the result of this study will support investors in analyzing and making informed data-driven decisions. So in my next video, I'll be showing us the analytic processes as well as our conclusion. So thank you very much for your time so far, and you have a nice day, and don't forget to subscribe to our YouTube channel. Thank you.